and Pharmaceuticals in association with Higher Secondary Principals Forum.
Hello students, welcome to the class of Secretarial Practice, second session of Secretarial Correspondence with Banks. In the previous session, you learned about the banks, meaning of the banks, functions of the banks. You also learned about the different forms of the bank depending upon what exactly they do in the society. While at the same time, you also spoke about the different deposits, accepting of the deposits, the first part of the most important function of the bank. And under that you spoke about the different accounts, that is a current account, you learned about the saving bank account, you also learned about the fixed deposit account and also about the recurring deposit account. Today, we will move on to the next session, the second session of this lesson, which we will start from the different forms of the lending. Then we will speak about the negotiable instruments, that is a check and the demand draft, and also the electronic banking, that is e-banking, and the different concepts of the e-banking. Let's move on to the first part after the different types of the accounts. Well, I have said that the bank, every bank in India have to perform the two most important functions, and that is the borrowing, accepting of the deposits from the people, and the same money accepted from the people need to be given to the needy people in form of the advances, in form of the loans. And this is called as a lendings. So the money which has been given to the needy people, the funds which are given to the needy people, the loans and the advances which are given to the needy people is called as lendings. Then there are different forms of lending depending upon what each type of the lending or for what purpose this type of the lending is being used. They are called in the different names. So let's talk about the different forms of lendings. The first lending we talk about is a demand loans. Demand loan means the loans which are being sanctioned, the entire loan which is being sanctioned is transferred to the account of the debtor, either in form of a cash or it has been transferred to the account of the debtor, is called as the demand loans. And in this type of the loan, the money is recovered by the banks on demand. The money which has been lended to the needy people, the money which has been given in form of the loans and advances to the needy people is been recovered in certain number of installments on demand from the customers who are the debtors of the company. We have borrowed the money from the company, and this is called as a demand loan, where money is recovered on demand. The interest is charged on the entire amount which has been transferred in the account of the debtor, which has been transferred in the account of the loanee. The day it has been transferred in the account of the loanee, the interest is charged on the entire amount. It can be either transferred in the current account or it can be transferred in the saving bank account. You need to have either a saving bank account or a current account in order to take the demand loans or the demand loans, that is called as a demand. So here interest is charged on the entire amount. Next comes is a term loans. Term loans are granted for a fixed period of time, and the total repayment of the loan amount along with the interest is distributed in certain number of installment for a fixed period of time. If you have taken this loan for a period of maybe say for example 10 years, then the repayment installments will be spread out for 10 years for this number of months, and you are paying every month a fixed amount of installment for 10 years period. So, till the completion of the 10 year, the customer is repaying the loan to the bank. So, this is called as a term loans. In case of the demand loan, period is not important. You can pay it according to your convenience. You can repay it according to your convenience. But in this case, now the latest thing, if you try to understand, if anybody knows about it, government was giving HBA, that is a house building allowances to the government employees on 2% of interest. Initially it was 6%, but now in the lockdown it has been increased to 8%. Now this particular type of the loan is a term loan. The amount which has been given to the government employees is been spread out till the retirement of the employee, which means till the last month when this employee is drawing the salary from the government treasury, he will have to make the payment of installment to the government under this HBA, that is a house building allowances. This is called as a term loan. So, this is another type of the loans which are been given to the customers. Next comes is about the overdraft. Overdraft is another loan facility given to the businessman. Overdraft facility is given only to the businessman in the current account. I have said earlier that current account is an account which is most suitable to the businessman, because here in this account overdraft facility is allowed to the account holder. Now what is mean by overdraft facility? Overdraft means the account holder, I mean the current account holder, is allowed to overdraw the account, which means the current account holder is allowed to withdraw more than the credit balance of the account. So, for example, in the current account of a particular businessman, there are only 50,000 rupees in the credit of this current account, but that businessman on particular day requires 1 lakh of rupees, but in the credit balance there is only 50,000. So, bank gives the overdraft facility to this particular account holder against the collateral security, against the security of shares, securities, debentures, insurance policies, against the security of such collateral. The overdraft facility is allowed, which means that person is allowed to withdraw 1 lakh of rupees, in which 50,000 is his own money and 50,000 is the loan that is taken from the bank for a particular period of time. Within that period, they have to return it back to the bank, and that is called as an overdraft facility. Now comes the customer is withdrawing 1 lakh of rupees, in which 50,000 is in which was in as was the credit balance of his account, which means 50,000 was already there in his account, but 50,000 rupees he is taking extra from the bank. So he will be charged interest only on this 50,000 excess he has withdrawn from the bank for the period he is using this particular money, and that is called as a overdraft facility. Maybe on the next day he get the money and deposits it in the account, that 50,000 rupees plus another 1 lakh is depositing, 2 lakhs is depositing, which means that 50,000 he has used on the previous day is been returned back to the bank. So he will be charged interest on only 50,000 rupees, which is the bank money, for only 1 day, and that is called as a overdraft facility. So many times businessmen are in shortage of funds for a short period of time, maybe 1 day, half day, or 2 days, or 5 days, or 10 days, or maybe a month. So they are in short of funds. So that time this account holders, businessmen use money of the banks for a short period of time, and they are charged interest only on the excess amount they have withdrawn from the bank, and that is called as a overdraft facility. So this is one way of using the money of the bank, one way of taking the loan. This is also another facility given to the current account holders. I am saying current account holders. If you want overdraft facility, then compulsorily you should have a current account in that particular bank. Next comes is about the cash credit, another facility provided to the businessmen, to the traders, to the industrial owners, to the people who are involved in the commerce, in order to use the credit from the bank. So this is a separate account by itself. You don't have to have a saving bank account, or you don't have to have a current account to have a cash credit. Cash credit is a separate account by itself, in which businessmen borrow money from the bank up to a particular limit, and you are not allowed to withdraw above that particular limit. You can either withdraw this much of money at once, or you can withdraw it number of installments. But once you reach to that particular limit, you are not allowed to withdraw more than that particular limit, which is called as a cash credit. This is most suitable to the businessmen in order to fulfill their working capital requirements. Say for example, this is again given against the collateral security, like shares, bonds, securities, insurance policies. Against that security, this type of the facility, this type of the loan facility is given to the businessman. So what exactly is done here in the cash credit? Say for example, you are given a credit limit of 10 lakhs of rupees, say for example. So one day you are allowed to use 2 lakhs of rupees. Another day again you are in need of the money. You are allowed to withdraw again 3 lakhs of rupees, total 5 lakhs. Again 5 lakhs of yours is still there, which you can use. You will be charged interest for 2 lakhs first, and then again 3 lakhs. When total 5 lakhs of rupees, you will be charged interest for the days you are using this money. Now what happened? You got money. Suddenly you got some payment from somewhere of 3 lakhs. You deposit that money. So what is your credit now? Of only 2 lakhs. You have taken only 2 lakhs, because 3 lakhs you have paid already. So you have withdrawn only 2 lakhs of rupees. So you are paying interest from the day you have deposited 3 lakhs of rupees. You will be paying interest only for 2 lakhs of rupees. Now suddenly you are in need of money. You want 8 lakhs of rupees. So you withdraw 8 lakhs plus previous 2 lakhs, total 10 lakhs. So your limit is over now. You cannot withdraw more than that. Now, unless and until you deposit money in the account, you cannot withdraw. So you will be charged interest for 10 lakhs of rupees for this till you repay the payment. You cannot go beyond this 10 lakhs of limit. This is called as a cash credit. So as the money comes to you, you deposit the money. When you want the money, you withdraw the money, you use the money, but only up to 10 lakhs of rupees. When you get the money, when you get payments, you deposit in the account. So your credit will come down. If you have deposited 5 lakhs, now 5 lakhs is loan, 5 lakhs is yours. So you are paying interest only on the 5 lakhs, the amount of money you have used. But once the limit is over, you cannot go beyond the limit. You cannot exceed the limit. So only 10 lakhs is your limit, and this is called as a cash credit. This is another facility given to the businessmen, to meet their regular working capital, to meet the requirements of the working capital. This is again one type of the loan facility given by the bankers for a temporary period of time, and the fixed rate of interest is being charged only on the actual amount withdrawn and not on the maximum limit. If your limit is 10 lakhs, it does not mean you will be charged interest on the 10 lakhs. If you have withdrawn only 5 lakhs, you will be charged interest only on the 5 lakhs, not on the 10 lakhs. 10 lakhs is the limit. You can withdraw up to 10 lakhs of rupees. And when you reach to the maximum limit, that is 10 lakhs, then only you will be charged interest only on the total 10 lakhs of rupees. And that is called as a cash credit. Next comes is a discounting of bills. When we talk about the bills, bill is a bill. Whenever you go to any of the shop, you buy something and you ask for the bill. That is a bill. But in business, when it comes to the trade transactions, when the supplier sells something to a buyer, many times there is a possibility of the credit transaction. So which means you don't make the immediate payment, you don't make the spot payment when you take the delivery of goods, buyer take the delivery of goods, but buyer postpone the payment to the future date, maybe after 15 days or after 1 month or after 3 months, because it cannot be more than 3 months, more than 90 days. Okay, so that is called as a bills of exchange. You have this bills of exchange in the accounts, means when there is a buying and selling between buyer and seller, because in the credit transaction or any of the transaction there are two parties involved. One is a buyer who buys the goods, who take the possession of the goods, and another one is a seller who sell the goods, who transfer the possession of the goods. Now there are two parties, but it is a credit transaction. Now when the buyer take the possession of the goods, buyer is supposed to make the payment. But the buyer does not make the payment, but the buyer agrees to make the payment after 1 month. He says, today I cannot make the payment. I don't have money today. I will pay you money exactly after the completion of 1 month. Then the bill is given. Seller gives him the bills mentioning, say for example, he has sold some goods to him. Say for example, 100 units of shoes, say for example. Per cost of the shoes is, say for example, 950 rupees. Total amount comes to, say for example, 95,000 rupees. Now this is the bill he has received. He will check the bill. He will see whether everything is written correctly. He will tally whether 100 pair of shoes are there or not, whether all are good quality or not, whether the color that he has demanded, whether the right color has come or not. He will try to match it with the bill and the physical inspection he will try to do. So once he is satisfied, on the reverse side of the bill, he will write it as accepted, and he will write below that due date, and he will sign it. Due date maybe, say for example, 20th of December is the due date he has written. What is the meaning of that? Means I have accepted this bill of yours. I have agreed this bill of yours, but today I am not making the payment, but I am making the payment on 20th of December, this total 95,000 of yours. And this is called as a bills of exchange. Bill is being exchanged, and this bill is being sent back to the seller who has sent the bill. Now who is holding the bill? The seller is holding the bill, the accepted bill. The payment seller will receive on 20th of December, but suddenly on 15th of November, seller who has sold shoes and who is expecting the payment on 20th of December suddenly is in need of money. He is in badly need of money. Now what can be done? He cannot go to the buyer asking for money again. He cannot go and cry there and say that no, I want money. I am in badly need of money. No, I cannot manage without it. You cannot say that because it's a business. You cannot do like this. So what you are doing? You are going to your bank. You are telling the banker, I have sold so many goods to so and so person. That person has accepted the bill and he will make me the payment on 20th of December. So banker says, against this bill which has been accepted by so and so person, I am ready to give you the loan on 15th of November. 1 month, 5 days before the expiry or before the due date. So bank says, I am giving you loan of 95,000 rupees. But what the bank is doing? Bank is not giving 95,000 rupees to the person who is going there to take the loan, but bank is giving him 90,000 rupees. 5,000 rupees is deducted as an interest of the 35 days, and 90,000 has been given to that particular party, which is called as encashment of the bill before the due date. Means the bill which otherwise would have been encashed on 20th of December is encashed by the banker on the 15th of November, 35 days before the expiry of the period, before the due date, and the interest is charged in advance. 5,000 rupees is charged in advance as an interest, which is called as a discount. And that's why this type of the situation is called as a discounting of bill of exchange. The bill which was actually would have been honored on 20th of December is encashed on the 15th of November by charging 5,000 as a interest, which is called as a discounting of bill of exchange. So when on 20th of December, this person who is supposed to pay the money will not go to the seller, but will go to the bank, pay 95,000 rupees, and the transaction is over. This is called as a discounting of bill of exchange. Another way of giving the loans by the bank against a bill. This is called as a discounting of another way of giving the loans. Next is a credit instruments or the negotiable instruments. I have told you whatever money is received by the banker in form of the deposits is then given to the needy people in form of the loans and the advances. There are different forms of the loans and advances, like demand loans I told you, term loans I told you, overdraft facility, cash credit, and the discounting of the bill of exchange. So these are the different ways of financing the needy people, giving loans and advances to the needy people. Now we will talk about the negotiable instruments. There are different instruments used in the banking sector, different credit instruments used in the banking sector. So negotiable instruments are the credit instruments which are used to make and receive payments, which are used to demand for the payments, and that is called as a credit instruments or the negotiable instruments. There are many types of the negotiable instruments like check, promissory note, demand draft, bills of exchange. These are the different forms of the negotiable instruments, but we will be talking about most important instruments which are used as the credit instruments. So let's talk first about the check. Check is a credit instrument which allows their customers to withdraw money from other banks. It is the most inconvenient and the inexpensive medium of exchange. Check is called as an instrument in writing. When you talk about the check, it is always an instrument in writing containing unconditional order. There cannot be conditions on the face of the check. Containing unconditional order signed by the drawer directing another person to pay a certain sum of money to the order or to the bearer of the instrument, and this is called as a check. Check plays a very, very important role. It is very clearly said here. The first thing is the unconditional order. If you have seen check, no, or say for example, when we are talking about the check, if you see a check, it is always unconditional. You will not see any of the conditions on the face of the check, like if, then, so, but. This type of the conditions will not be seen on the face of the check. Pay to. So for example, Mr. Joseph Fernandez, if there is a amount or a balance in the account, you will not find this. Pay to Joseph Fernandez sum of rupees 2,000 rupees directly. If, then, but will not be there. So it is always unconditional. There cannot be conditions on the face of the check. You cannot write any of the conditions on the face of the check. That is called as a check. Next is written and signed by the drawer. The drawer who has an account in that particular bank. Drawer is the account holder who has the account in that particular bank. Has to write on the check the name of the person, the amount in words and figures. The signature of the drawer should be there, otherwise that check will be invalid. It will not have any meaning. So it should be always written and signed by the drawer. If it is not written, then it is called as a blank check. If it is not signed, it is called as a blank check and it has no value in the bank. If you produce this check on the counter of the bank, no banker will pay you money. It has to be always written and signed, issued on a specified bank. It is issued on the specified bank in which bank that particular drawer has the account. If say for example, I am giving you the check of a Bank of India, I am writing the name of the person, pay to and then I am signing it, then the person who is going to withdraw money should go to Bank of India only, cannot go to Canara Bank and to withdraw the money. It should be on a specified bank in which bank I have an account. So it should be always a specified bank. Amount in figures and words should tally and match. Again, very important. On the face of the check, there is always provision to write the amount in words. Say for example, 50,000 rupees, after writing 4 zeros. And also there it should be written in the words which should tally. If you are writing in words 5,000 and in figure if you are writing 50,000, and if it is not matching, your check will not be honored. It does not have any value. So it has to be always written in figures and the words. Addressed to specified bank. This particular check should be addressed to a specified bank. You cannot have options here. This bank or that bank or that bank. Specified. One specific bank in which you have an account. So that talks about a check, a very important instrument which has been used to make and receive the payments in the banking sector. There are the different types of the checks. Now this check that I have told you, it should be unconditional, it should be signed by the drawer, it should be written by the drawer, there should be date on the check, there should be specified to a particular bank, all those things which should be there. There are different types of the banks. Let's talk about the types of the bank. There is something called as a bearer check. Bearer check is a check where the holder, the bearer of the check can encash this check on the counter of the bank. When the name of the person, pay to Ankit Sharma, date will be written and or bearer is written on the face of the check. Whoever is the bearer of this check, say for example, here it is written as Ankit Sharma, and if he misplaces this check outside the bank, and if the check is found by Ankita Sharma, then Ankita Sharma can go to the counter of the bank and withdraw the money. There is no need of the identity of the person whose name is written here on the face of the check. Anybody who is a bearer of the check, anybody who is holding this check can go to the counter of the bank and ask for the money. Banker does not have a right to ask for the identity of that particular person as per the law. But now, to avoid many complications, nowadays bankers are asking for the identity of the person if it is a bigger amount. Then that is been done for the safety of the banker and in order to avoid the fraud. This type of things are being done. But according to the law, according to the Banking Regulation Act, nobody can ask for the identity of the person if it is a bearer check. Anybody who is a holder of the check can go and encash the check. The name is not checked, name is not verified. Only the signature will be verified. Amount, whether it is matching in words or figures, that will be verified, and that's it. You can encash the check anywhere, I mean on the counter of the bank. Next comes is a cross check. Another check in order to avoid the wrong payments to the wrong party, to the bearer. This type of the checks have been used by the drawer, by the account holders. Cross check means a check where two transverse parallel lines are being drawn on the face of the check with or without the word account payee, with or without the word not negotiable. This is called as a cross check in order to avoid the wrong payments. I told you in the previous case, bearer check, anybody who is holding the check can withdraw the money from the counter of the bank. And there is possibility of wrong payments. I mean the possibility of making the payment to the wrong party. But here in this case, there is no possibility of making the wrong party. Because when a check has been issued on the name of one particular person, say for example, Roy Angley. If this check is issued on the name of Roy Angley, then Mr. Roy Angley has to deposit this check in his account. Money will be transferred from the account of the person who has signed here, and Mr. Roy Angley can withdraw money only from his own account. He directly cannot withdraw it from the account of the person who has issued this check, who has signed here. First the money will come in your account, and from your account you can withdraw. So there is no possibility of any wrong payments. No possibility of wrong payments, and that's why the facility of the cross check has been introduced, so that payments are not made to the wrong person. Okay? So this is called as a cross check. There is something called as a order check, which has been issued on the order of the person. Now here there is a difference between the bearer check and the order check. Here the word bearer, mostly here on the check, the word bearer is written. So what is done? The word bearer is cancelled and the word order is written on the face of the check, which is called as a order check. So here the name of the person will come, here the amount in words will come, here the amount in figures will come, here the account holder will sign, and here only the difference here will be the word bearer will be cancelled and word order will be written. So what is the difference, major difference between the bearer check and the order check? Here you require the identity of the person. In case of the bearer check, you don't require the identity of the person, but here you require the identity of the person. Here banker will ask for the identity of the person, maybe the PAN card or maybe the identity card or whatever, the identity card, where the number of that identity card will be written on the reverse side of the check to verify the identity. In future, if there is any confusion, any problem, you can easily verify to whom you have paid this particular amount. So this is called as a order check. This is called as an order check. This is again in order to avoid the wrong payments. But this can be paid on the counter of the bank. Cross check cannot be paid on the counter of the bank. Order check can be paid on the counter of the bank only by proving the identity. That's the difference between the bearer check and the order check. Next comes is a post-dated check. Another type of the check which has been issued by the bank, issued by the drawer, account holder, which is called as a post-dated check. Here everything will be same. Now say for example, name will be written here, pay to Roy Angley. Say for example, amount 50,000 rupees in words, 50,000 in figure, sign of the account holder. Because if the signature of the account holder is not there, then your check is useless. It does not have any value. Signature of the account holder has to be always there. And it should match with the specimen signature. Means at the time of opening the account, you are asked to sign in the 3 places on our particular card. So out of these 3 signatures, at least one signature should match with this, because over a period of time, there is a possibility of changing your signatures. There is a possibility of changing the signature. So here, this signature of the account holder should match with that card on which you have signed in the 3 places. So always, every time, whenever any check goes to the banker, he will first open the computer and see your specimen card where your signatures are there. He sees whether it is matching or not. If it is not matching, then they say your signature is not matching. Sign it again if you are the account holder. Or he will tell the person, if any other person has gone, he says signature of the account holder is not matching. Please call the person or go and get one more signature. So it is always required the signature should be there. But the difference here is the date is a future date. Say for example, today. Today is, say for example, the 20th of November. 20th of November. I am issuing check to a particular person, maybe the Roy Angley. Here, I am writing the name of the person. I am issuing him check today. But I am not writing today's date, but I am writing the date of 25th of December, 1 month later. Future date. This is called as a post-dated check. The date which is written on the face of the check is the future date, then the date of issue. Then the date of issue. Means today if you go to the bank to withdraw money or you deposit your money in the account, it will not be encashed. It will be encashed only on the 25th of December. You cannot withdraw this money before 25th of December. The reasons might be different. The account holder might not have money in his account today, or may not come money till 25th of December. So he knows that 25th of December there is one FD which is getting matured and money will come on 25th in my account. So on that day you withdraw money, and that's why he is writing the date as a 25th of December. It is called as a future date, or reason might be different. He want to postpone the payment. He does not want to pay now. Take your money after 2 months, or maybe reason something else. But this type of a check where the post date is written, future date is written, then the date of issue, this is called as a post dated check. There is also something called as an antedated check, which means you are issuing check today. Today is 20th of November, say for example, but you are writing the date here is 6th of October. You are writing the date here as a 6th of October. No, some days back, some days early, that is called as an antedated check. This is also allowed to do. Maybe sometime what happens while writing the entries in the books of accounts, you have to make some adjustments in the books of accounts by showing the payment 1 month early or 6 months early or 2 months early. You have to show some adjustment in the books of accounts. So you cannot issue payment today, you cannot show it. So you have to show make some adjustments in the payments. So you issue it earlier date, that is called as a earlier date. Antedated check, the date which is mentioned here is antedated, the date before the few days or few months. Okay, but only thing you have to keep in mind that you cannot put the check for payment for withdrawal more than 3 months. Say for example, if today is 20th, you cannot write the date on the check 3 months early, it becomes stale. It becomes stale. You cannot put the check 3 months, date on the check 3 months early, because a check which has been put for payment after the 6 months from the date which has been written here will be a stale check. It cannot be encashed. It is useless. Either you have to go to the same party and ask him to issue another check, or you have to forget about that payment if that person is not giving you another check. So the check becomes stale if you don't put it for payment within 3 months from the date which is written here. This becomes a stale check. Earlier it was 6 months, but now of late it has been changed. The resolution has been passed, and the banking regulation, it has been changed, made to 3 months. So if say today, if the check has been issued, today is 20th of November, then 20th of December, 20th of Jan, 20th of Feb. So before 20th of Feb, before 3 months, within 3 months you have to deposit this check, or you have to withdraw the money. Otherwise your check becomes useless, your check becomes stale. So this check which has been presented for payment after 3 months from the date of issue, it is called as a stale check. It has no value in the banking sector. So this is another type of the check. So these are the different types of the checks that we have discussed. I have told you about the bearer check. I have told you about the order check. We spoke about the cross check. We spoke about the antedated check, post-dated check, and the stale check. So these are the different types of the check which can be used by the drawers to issue, which can be used for making and receiving the payments. The reasons why this type of the checks are issued, the reasons might be different. It might vary from a person to the person. But this type of the checks can be issued in the banking sector. Okay? So that's about a check. Next negotiable instrument which has been used for making the payments is a demand draft. This demand draft is out of fashion nowadays because of the electronic transfer of money. But there is one instrument, because mostly till today this type of things which has been used mostly for making admissions in the colleges, making some filling some tender forms in the government departments. For those purposes, demand draft has been still used. This is another type of the instrument which has been used to transfer money from one bank to another bank, or from one branch of the bank to another branch of the bank, which is called as a demand draft. A demand draft is a negotiable instrument similar to the bill of exchange. A bank issues a demand draft to a client, that is a drawer, directing another bank drawee or on one of its own branch to pay a certain sum of money to a specified party. and this is called as a demand draft, which was used many times by many of the businessmen, many years, long years, to transfer money from maybe from one branch to another branch, because it was very difficult to carry money in those days. No, now there is a development in the banking sector, but in those days if you want to carry maybe currency of maybe 1 crore of rupees from one state to another state, it was very difficult and very risky. You cannot carry a bag full of money from one state to another state. And that's why this bank draft were very useful for transferring the money from one country to another country, or from one state to another state, for making any of the business transactions. So with a small piece of paper, even the crores of rupees you could transfer from one bank to another. Very simple. So here there is no chances of dishonoring of the check, because when the bank is giving you the demand draft, you have already deposited the money there. You will not get a demand draft unless you have deposited the money. In case of the check, there is a possibility of dishonoring of the check. You may issue the check without having the credit balance in your account, but in case of issuing the demand draft, you have to first deposit the money, and then only bank will give you the demand draft to transfer your money from one bank to another. This was called as a demand draft. Now this demand draft, it has its own features. It is drawn by a banker upon its branch or upon another bank. Customer does not draw this demand draft. Customer has no right to draw the demand. It is a bank which draws the demand draft to another bank or another branch of the bank. One bank transfers money from one bank to another bank. Next thing, it is payable on demand, and that's why it is called as a demand draft. So on demand, this money is being transferred from one place to another. It cannot be payable to the bearer, the one who is a bearer of the instrument, the one who is a holder of this demand draft. He cannot encash this money. You have to deposit into somebody's account, and you will get the money there in that account, and from where you can encash it. You cannot directly go to the counter of the bank. I have a DD. Give me money, 5 lakhs of rupees. You cannot say that. Deposit this DD in your account, whose name is written on the face of the demand draft, and from that account you can withdraw it. Next comes, it cannot be stopped except by the order of the court. If the DVD has been issued, you cannot go and say, no, I don't want to make this payment to this party. You cannot do that. Only you have to take the order of the court to stop the payment of the demand draft. Once the demand draft is issued on the name of a particular person, it will be surely credited on the name, to the name of that particular account. You cannot stop it. You have to take the order of the court, and then only it can be stopped. So that's about a demand draft. There's some difference between the check and the demand draft. Many times we confuse with the check and the demand draft. There are some differences between check and the demand draft. First thing, who issues it? Check is been issued by the account holder. Demand draft is issued by the bank. See the difference. Check is issued by the account holder who has an account in a particular bank. He is a drawer of this check who signs this particular check. But the demand draft is issued by the banker, and the bank officer signs the demand draft. So that's the difference between the check and the demand draft. When payment is made, in case of the check, when the check is been drawn on the bank, when you go to the account or when you go to the counter of the bank, you get the money. The bearer of the check gets the money. Demand draft, bearer of the check does not get the money. It is always credited in the account of the person whose name is written on the face of the demand draft. Next come is dishonored. Check can be dishonored. I have said it earlier. Demand draft cannot be dishonored, because when the demand draft is issued by the bank, money is first accepted and then the demand draft is been issued. So no dishonoring of the demand draft. To whom it is been paid? Check is always paid to the payee whose name is written on the face of the check. Demand draft is paid in the account of the payee whose name is written on the face of the check. That's a difference. Here it can be encashed on the counter, there it cannot be encashed on the counter. Parties involved in the check. One is a drawer who signs the check. Second one is a payee in whose favor check is been issued, that is whose name is written on the face of the check. And third is a drawee, which means the bank which makes the payment. Three parties are involved. Drawer is the person who signs the check, account holder. Pay is the person whose name is written on the face of the check to whom the payment will be made. And third is the drawee, who's the party who makes the payment, that is the banker. In case of the demand draft, it is the drawer and the bank, drawee. There is no pay here. Okay. Next comes the signature. On the check, the signature of the account holder is required. The signature of the drawer is required. In case of the demand draft, signature of the bank officer is required, not the drawer. Bank officer is required. That's the difference between the check and the demand draft. So we have come to the end of the second session of the Secretarial Correspondence with the banks, in which you have learned the different forms of the lending. The money that is accepted by the bankers is given to the needy people in different forms of the lending to make the use of it and to grow in their life and also in the businesses. We have also learned about the negotiable instruments, that is a check, how the check has been used for making and receiving the payments, and also the demand draft, which is used for transferring of the money from one bank or from one branch of the bank to another branch of the bank. So we have come to the end of this session, second session of this particular chapter, that is the Secretarial Correspondence with banks, and we will meet in the third session of the Secretarial Correspondence with the banks to learn about the new concepts in the banking sector. Thank you.
Prudent Scholars, powered by Lupin Pharmaceuticals.
अब आपकी सुरक्षा आपके हाथों में। ल्यूपी सेफ हैंड सैनिटाइजर, आपका और चेन्नई सुपर किंग्स का फर्स्ट लाइन ऑफ डिफेंस। अब आपकी सुरक्षा आपके हाथों में। ल्यूपी सेफ हैंड सैनिटाइजर, आपका और चेन्नई सुपर किंग्स का फर्स्ट लाइन ऑफ डिफेंस। अब आपकी सुरक्षा आपके हाथों में। ल्यूपी सेफ हैंड सैनिटाइजर, आपका और चेन्नई सुपर किंग्स का फर्स्ट लाइन ऑफ डिफेंस।